All right, now we're going to go into financial statements, which is chapter 4. Using the below noted listing, create all of the financial statements for the December 31st, 2021 year end, including the cash flow statement in good form. The two right-handed columns will help you organize the accounts, right? So we're going to tackle this question, and then we're going to answer these questions below. So let's go through each one and figure out the element is, then which financial statement is going to go under. The element, it could either be asset, liability, equity, revenue, or expense. If it's a cash flow statement, it could be investing, operating, or financing. So this chapter is very important. So if this chapter does confuse you, I highly suggest that you guys go back to the actual chapter 4 and go through it in detail. Because not only does the elements in the financial statements matter, the formatting is just as important. And furthermore, the element, if it's an asset, it could either be current or property, plant, and equipment, intangible. We have to differentiate that as well. If it's a liability, it could either be current or long-term, and equity is equity. So let's dive right into this. So accounts payable is simply a liability, and it's going to be current. And this goes on to the balance sheet. So IS is income statement. S of RE is going to be statement of retained earnings. BS is going to be balance sheet. CF is going to be the statement of cash flows. So this is going to be the balance sheet. Accounts receivable is an asset. It's a future benefit. It's going to be current as well. Remember, anything that's current is less than 1 year, right? And then the financial statement is the balance sheet. Additional, a cash received from its owners. This is going to be the cash flow statement. This is going to be a financing activity. And it's going to be cash inflow because we're receiving cash. Cash is going up. Bank loan payable due in 2023. So remember, this right now we're doing for 2021. So that's clearly going to be long-term. Bank loan payable. So any payable is going to be a liability. So liability, and since it's going to be due in 2023, that's going to be long-term. And this is going to go onto the balance sheet. Business license is an asset, and this is going to be an intangible asset. So an intangible asset is essentially a long-term asset that doesn't have physical substance. So when we say physical substance, that means we can't physically touch it, but it still provides us with a value. And this is going to go on to the balance sheet. Cash is cash. This is going to be an asset. It's going to be current. Go on to the balance sheet. Cash collected from customers. Cash pay for dividends, cash pay for intangible assets, cash pay for interest, cash pay to suppliers, cash received from the bank, cash opening balance. These are all going to go onto the cash flow statement. All right, so cash collected from customers, that's going to be operating since we collected it. So remember, under the cash flow statement, we have operating activities, which has to do with the day-to-day business transactions with more related to current assets and current liabilities. Then we have investing activities, which is investing in the future growth of the company. That's to deal with long-term assets, such as long-term investments, property, plant, and equipment, and intangible assets. Then we have financing, which has to do with funding our operations. That has to do with equity financing and debt financing in terms of long-term liabilities. So cash collected is a cash inflow. Now, cash paid for dividends, that's financing because dividends is a payment out to our shareholders. That's a cash outflow. Then we have cash paid for intangible assets, that's investing. That's going to be cash outflow. Then we have cash paid for interest. Interest you pay on a yearly basis, so that's going to be operating. Cash outflow. Cash paid to suppliers, operating cash outflow. Cash received from the bank, that's financing. Cash inflow, because we're receiving cash from the bank. Cash opening, it goes onto the cash flow statement, but at the very end. So we're just going to write So this is not available, right? Dividends, this one goes on to the statement of retained earnings, right? As simple as that, statement of retained earnings. The element is not available, but that will be essentially equity. Income tax expense is an expense, simple as that, right? That goes on to the income statement, IS. Income tax payable is a liability, and that's going to be current because obviously we're going to pay income tax within 1 year, right? That goes on to the balance sheet. Insurance expense and interest expense, these are both expenses. And these go on to the income statements. Remember, income statement has revenue minus expenses. Statement of retained earnings has a beginning retained earnings balance plus profit, which is from the income statement, minus dividend gives us ending retained earnings. Balance sheet has the assets equals liabilities minus equity, and the two main accounts under equity are owner's capital and retained earnings. So the ending balance and retained earnings is going to go onto the balance sheet. And the statement of cash flows deals with cash coming in and cash going out of the business, right? Then we have interest payable. Remember, payable is a liability. Interest is due within 1 year. That's going to be current. Balance sheet. Owner's capital is simply going to be equity or shareholders' equity. Balance sheet. Prepaid insurance. So this is when we pay for something in advance. So now the insurance company owes us the service. That's a future benefit. That's an asset. Obviously, we want it within 1 year. So it's current. Balance sheet. Rent expense. Expense, income statement, retained earnings. This is going to go on to the statement of retained earnings. This is going to be the beginning balance. So statement of retained earnings. Remember, this is equity, but for this purpose, we're right not available, just to avoid a little bit of confusion. Salaries expense, income statement. Service revenue. This is the revenue. Goes without saying. Right over here, we have deferred revenue. So we'll do that in like 2 seconds. And this, so remember, service revenue goes onto the income statement. Now we have deferred revenue. Deferred revenue and unearned revenue are the exact same. So we haven't earned that revenue yet. That's why it's deferred. So that's not a revenue, right? That's going to be under liability as a current. So deferred revenue or unearned revenue is now, so someone pays us in advance for a service, so we have to deliver it in the future. That's a future obligation, which fits the definition of a liability. So this over here is going on the balance sheet. Supplies is an asset, that's current. Balance sheet. Supplies expense, that's an expense. So that's when we use up the supplies, right? Whereas supplies, we haven't used them up yet, so we're still going to use them. Future benefit, asset, we used them up, expense. So supplies expenses is going on to the income statement. Travel expense, once again, expense, income statement. Then we have website design. This is going to be an asset, and this is going to be intangible. This is going to go on to the balance sheet. So now we're going to tackle the income statement first, right? So for the sake of simplicity, so it's easy for you guys to follow along, I put all of the income statement accounts in yellow, right? So whenever we have a formal financial statement, it's a 3-part title: company name, statement name, and then the date. The company name it's not given to us in this question. That's fine. We'll make that up. We'll label that as whatever, doesn't really matter. Company name Inc. This is going to be the income statement, and the date is simply going to be for the year ended December 31st, 2021. For the year ended December 31st, 2021. All right, so we're going to start off with the revenues first. And we only have one revenue account, which is service revenue. And I'm going to indent service revenue in Excel by clicking space twice and then writing it down. Obviously, if you're doing it on paper, just leave a little indent. This just makes it easier for the eyes. And service revenue is 225,000. Since we only have one service revenue account, we put it over here. If we have more revenues, we put them over here, then calculate the total, put it over here. Next, we're going to go over to operating expenses. So for operating expenses, we're going to list them in the order of the highest to the lowest. So we're going to include all the expenses other than income tax expense. So The highest amount is going to be salaries expense. Salaries expense. Since we have a bunch of them, we're going to put them in this column over here. Is going to be 85,500. Then we're going to have rent expense. Let me write them out first, and then I'll list the totals or the amounts. And then we have supplies expense. And then we have travel expense. And so remember, it has to be indented, very important. It's easier for the eyes. And then we have the income tax expense is not included. Then we're going to have insurance expense and interest expense. So we said rent expense is going to be 32,460. Supplies expense is 2,250. Travel expense is going to be 17,100. Insurance expense is going to be 10,800, and then interest expense is going to be 10,800. All right, next we're going to calculate our total operating expenses, and this is going to be a product of 85,500 plus 32,460 plus 2,250 plus 17,100 plus 10,800 plus 10,800. So 176,910. Once again, we're going to add all these together. Then this minus this is simply going to give us profit before income tax. Or profit before income tax. Yeah, exactly. So this number is going to be simply put the 225,000 minus the 176,910. So 225,000 minus 176,910 to arrive at 48,090. So this minus this is this. Then we're going to subtract the income tax expense. So subtract the income tax expense, which is 13,380, right, to arrive at the actual profit or net income for the period. So once again, this is going to be the 48,090. So 48,090 subtracted by the 13,380. So that's the total profit for the period. Remember, we put an underline whenever we do a calculation. Add these all together, underline this minus this, underline this minus this, underline this, and this is going to be double underline 34,710. All right, next we're going to dive into the statement of retained earnings. This one is fairly straightforward. So once again, a three-part title, company name, Inc., statement of retained earnings, and for the year ended December 31st, 2021. So now in this case, we're going to have the beginning retained earnings balance. So retained earnings opening or beginning, which is going to be the 38,235. Then we're going to add in the profit or the net income from above. We're bringing this down directly from the 34,710. And then we're going to subtract or deduct dividends. And this is going to be 26,700. So negative 26,700. This is going to give us our retained earnings ending or closing. So we're going to do a calculation here. So I'm going to put an underline. So simply put, we're going to do 38,235 plus 34,710 plus negative 26,700. So I'm going to sum these three together. To arrive at 46,245. So that wraps it up for the statement of retained earnings. Now let's go over to the balance sheet. So the balance sheet differs a little bit in the terms of the three-part title. So the first two parts are still the same: company name, Inc. Then we have the balance sheet, and then we're going to have now the just the day. So not for the month ended or for the year ended, just December 31st, 2021. And now we're going to start off with assets first. Okay, so assets, and then we have the subcategories, which is going to be current assets. So current assets are listed in the order of liquidity, right? So assets are listed in the order of liquidity. That simply means that whatever we can convert to cash the fastest, the general listing is always going to be cash first, then accounts receivable, then supplies, then inventory, and then any prepaid expenses that we have. So prepaid insurance, prepaid advertising, whatever we have. So this is always going to be the order, and this is the order of liquidity. This is very important. So we're going to first start off with cash first. So I'm going to indent this 5 times now. Press space 5 times. 1, 2, 3, 4, 5. Cash. And cash is simply going to be 54,000. Okay. Next is going to be accounts receivable. So accounts receivable, 1, 2, 3, 4, 5. And this is going to be 52,350. Next, we're going to have supplies. We do have supplies. And supplies is going to be 15,750. Let's see if there's any more. Let's see if there's any more current assets. I believe there's not, so we're good. We have 3. There's no inventory or nothing like that. There's no inventory because we have a service revenue, so we're a service company. That's why there's no inventory. Oh, there is prepaid insurance. Perfect. So let's update prepaid insurance as well. Prepaid insurance. And prepaid insurance is going to be 10,800. So now we're done with our current assets. Now we could total them up. So I'm going to put underline because we're doing a calculation, and we're going to write total current assets. And total current assets is going to be 54,000 plus 52,350 plus 15,750 plus 10,800 to arrive at 132,900. Next, we're going to dive into intangible assets. So we have no property, plant, and equipment in this specific question. That's fine. So we're going to do intangible assets. So once again, space 5 times. 1, 2, 3, 4, 5. We have business license. Remember, business license. The amount is going to be 1080. 1080. So I think you see there's a lot of back and forth in this case, right? Which is fine. This is just this type of question, and then we have website design as well. Remember, 5 times. 1, 2, 3, 4, 5. This is only if you're using Excel. If you're writing it out, please just indent it and make it look very clean, right? Clean. And the website design is 14,340. We're done with our intangible assets. So now we're going to calculate the total. Once again, underline, we're going to calculate total intangible assets. And this is going to be for the 1080 plus the 14,340, 15,420. Now we can calculate total assets, which is going to be the 132,900 plus the 15,420. So once again, we're doing a calculation underline. This is our final figure. Well, one of the important figures, so we're going to double underline that. So now we're done with our assets. We're going to go over to our liabilities. We're going to have current liabilities. So usually this is also listed in order of liquidity. The way I do it is I do accounts payable first, then do unearned or deferred revenue last. Whatever is in between, just put them in between. So we have accounts payable. And remember, accounts payable is all the way up here. It is 18,540. If it's easier, I suggest you guys print this out and make it much easier for you guys to follow along. So you don't waste time going up and down, right? So this is going to be 18,540. And then we're going to have income tax payable. 1, 2, 3, 4, 5. Income tax payable, which is going to be 6,000. Then we're also going to have 1, 2, 3, 4, 5 interest payable, which is going to be 135, and interest payable is going to be right over here. And then we have deferred revenue. Remember, deferred revenue is not a revenue, it's a liability because we haven't performed the service yet, but they paid in advance. So it's a future obligation. 1, 2, 3, 4, 5. Deferred revenue is going to be 2,400. Now we're done with total current liability, so we're going to calculate it now. Remember, underline because we're doing a calculation. Total current liabilities is going to be 18,540 plus 6,000 plus 135 plus 2,400 to get 27,075. Now we're going to go over to long-term liabilities. Remember, we do have this long-term liabilities, which is going to be 1, 2, 3, 4, 5. The bank loan payable due in 2023. So this over here is going to be bank loan payable, right? Due in 2023, which is going to be for 27,000. Since we only have one long-term liability, I'm not going to put in this column. I'm going to put this column right away, right? And then now we can calculate our total liabilities by simply taking the 27,075 and adding it to the 27,000. That's 54,075. Now we have equity. So equity is going to comprise of, there's no subcategories, it's just going to be owner's capital. So let's indent this 5 times. And owner's capital is going to be 48,000, right? And then we're going to have retained earnings now. 1, 2, 3, 4, 5. Retained earnings. Retained earnings is going to come from the statement of retained earnings, 46,245. We're going to add these two together to get total equity. So total equity, once again, underline is very important, is 48,000 plus 46,245. Underline is 94,245. Then we're going to get total liabilities and equity, which is going to be 54,075 plus the 94,245, which is 148,320. As you can see, it matches this. That count the equation balances. That's very important. If this doesn't match, then you did something wrong, right? You could have messed up in the classification, you could have missed an item, or you could have done a calculation error. So I always suggest my students not to rush this, right? Double check your work. If you have time, triple check it, because if this doesn't balance, then something's off. All right, next we're going to go into the cash flow statement, the last statement. So once again, company name Inc. In this case, it's called a statement of cash flows. Okay, statement of cash flows, and this is going to be for the year ending or the period ending December 31st, 2021. So as you can see, the only thing that differs is the date. Income statement for the year ended, retained earnings for the year ended, cash flow statement for the year ended. The only one that differs is the balance sheet, just the date, very important. So we're going to start off with operating activities first. Remember, we have operating, investing, and financing. Operating activities. So we're going to label this as cash flows from operating activities. And the ones that are going to be impacted are going to be essentially cash collected from customers, cash paid for interest, cash paid to suppliers, and that's about it, right? So cash collected from customers, let's do that first. So 1, 2, cash collected from customers is going to be for 212,220, right? 212,220, and then cash paid to suppliers is 181,335, and cash paid for interest is 10,665. So we're going to subtract those two now. So we're going to subtract cash paid to suppliers. I'm putting that first because that's more of a bigger expense, right? So that once again is going to be for 181,335 is negative because we're losing money, and then we're going to subtract cash paid for interest, and that's going to be for negative 10,665. So we're done everything for operating activities, right? So now we can actually calculate it. So simply put, 212,220 plus negative 181,335. I said plus, even let's say it's less over here because the negative is already going to subtract it automatically. Plus negative 10,665 gives us 20,220. So this is going to give us now cash provided by operating activities. Cash provided by operating activities. Now we're going to go over to cash flows from investing activities. And this deals with intangible assets, and that's about it. We only have one of them. Actually, no, sorry, intangible assets. Yes, sorry, just intangible assets, right? So simply put, we only have one item, right? But however, we have to write it separately. So this is going to be for cash paid for intangible assets, which is going to be negative. Once again, because it's cash outflow, we paid for it. 14,340. So remember, 14,340 over here, very important. And then this is going to give us cash outflow from investing activities. Cash outflow from investing activities, which is just going to be this over here. We're going to put an underline just to keep it consistent with this. And then lastly, we're going to have cash flows from financing activities. So this is going to include items such as additional cash from owners of 24,000, cash paid for dividends of 26,700, and cash received from the bank of, where is it, 27,000, right? So let's type this out. It doesn't have to be in any particular order. So I'm going to start off with cash received from the bank for 27,000, and that's going to be positive just because we're getting money. Then I'm going to do additional cash received from owners because they're investing money into the business now. And that's going to be for, like we said, 24,000. Positive as well because we're receiving money. And now we're paying out a dividends, right? So that's going to be less cash paid for dividends. That's obviously going to be a negative number now. So 26,700. Now we're done with all of our financing activities. We can calculate the total cash provided by financing activities. So cash provided by financing activities, which is going to be a product of the 27,000 plus 24,000 plus negative 26,700 to get 24,300. Now we're going to add up the cash from operating, cash from investing, and cash from financing, right? Remember, if we add a negative, it's automatically going to subtract it in our calculator. And this is going to give us our cash net inflow. So cash net inflow, or if it's negative, it's going to be outflow. So we're going to do 2220 plus negative 14,340 plus 24,300. Then we're going to add this to the beginning cash balance, which is given to us in here as well. Cash opening is going to be 23,820. So 23,820, and this should give us the cash ending balance. Cash ending balance or ending cash balance of 3,180 plus 23,820, 54,000. And to see if you did this correctly, this number over here should match this number over here. So essentially the cash flow statement, we're reconciling the beginning balance, the ending balance, and if this number does not equal this number, then you guys did something wrong. So remember, double check your work. It could be a calculation error, you could have missed something, etc., etc. So, all right, now that we're done the financial statements, let's actually tackle these questions. So is a business profitable What is the profit margin percentage? What are the largest expenses? So let's head over to the income statement over here. So the business is profitable as we have a profit of 34,710, right? Which is a fairly high amount, especially for the year, right? And then the next question is, what is the profit margin percentage? So the profit margin percentage is going to be the profit divided by revenues. So in this case, profit is 34,710 divided by 225,000 the profit margin percentage, and it's 15.43%. That's a fairly high amount. However, you won't know with certainty unless you have something to compare with, either a benchmark figure, a prior year's figure, or a competitor's number. However, the higher this ratio, the better. This ratio tells us for every dollar we earned in revenues, we were able to retain 15.43% or 15 cents. That means the rest went towards our expenses. What are the largest expenses? Salaries expense of 85,500, rightfully so because we have to pay our employees, right? Then rent expense is second. We have to pay for rent wherever our establishment is, wherever business is, right? So salaries expense, rent expense are our biggest expenses in this case. Review the balance sheet. Is there enough cash to pay off the current liabilities immediately? So our current liabilities are $27,075. We have more than enough cash to pay that off. So yes, we have $54,000 in cash, and our current liabilities is $27,075. Is there anything in the statement that concerns you? Explain why. So let's have a look at this. So our total current whatever here, accounts receivable is fairly high, 52,350, right? So why aren't our customers paying us? They should be paying us, right? So that's a fairly high amount. So imagine if these guys paid us, and that means our cash will be even higher, right? So our total current assets are fairly high. So that's a red flag, and that's because our customers owe us a lot of money. So we need to start collecting that, because the longer that they take to pay us, the more chance that they're not going to pay us, right? So we'll deal with that in a later chapter, right? Accounts receivable. And also, we have a lot of cash on hand. We should be better utilizing this cash either by investing more into tangible assets, investing into an actual building, equipment, etc., etc. So those are red flags. Anything else? Nope, I think everything else does check out, right? So the biggest red flag is accounts receivable and too much total, and as a result, we have too much total current assets. Is the business debt finance? So is the business debt finance or equity finance? How do you know? Be sure to show calculations that support your answers. Okay. So our total liabilities is 54,075. That's debt finance, right? Whereas our total equity is 94,425. That's equity finance. Okay, to calculate this, we can calculate the debt ratio, which is simply total liabilities divided by total assets. Because the way this works is we can finance our total assets by either total liabilities or total equity. That's why total liabilities plus total equity gives us total assets. It balances, right? So everything connects. So total liabilities is 54,075 divided by 1,48320, which is 0.3645 or 36.46%. Then we calculate the equity ratio, which is going to be total equity divided by total assets. So simply put, 94,245 divided by 1,48320 gives us 0.6354 or 63.54%. To arrive at this number, right, if you're doing it in a calculator manually, we could simply take this number 0.6354167 times by 100. There you go. That's the percentage, right? So as you can see, our total assets are financed majority by equity, as equity accounts for 63.54% of our total assets, whereas debt accounts for 36.46%. If we add these two amounts together, 36.46 plus 63.54, that's 100%, right? Once again, assets equals liabilities plus equity. Everything connects. Review the cash flow statement. What activity is the main source of cash? Do you consider this positive or negative? Explain why. So we have operating activities, 20,220. We have negative 14,340 in investing, and financing is 24,300. So our main source of cash is financing activities, right? This is positive because we're still expanding our business, right? So that's still a good thing. But you could put any spin on this, right? So for example, another spin on this could be that this is negative. That's not a good thing because we have enough operating activities, right? We have enough cash flows from operating activities to pay off our future investments, right? So operating activities, we want that to be positive. The higher, the better. Investing, we want that to be negative because we want to invest into the future growth of the company. And financing, it'll varies. If it's negative, that means we're also paying off our financing while investing into the business because we have enough money coming in from our day-to-day business transactions, right? So, but we go put another spin on it. So right now we're getting money from the bank and the owner's investing more money into it, so we could actually go out and buy a building, a piece of equipment now, right? So we're setting ourselves up for that for the next year, for 2022. It all depends on how the twist you put on it. But as long as you back it up with actual logical facts, your teacher shall not mark it incorrect. So that wraps it up for this question. Once again, very important. This question will be on the exam, so please consider it, right? This question could be in any format. It doesn't necessarily have to be in this format where you have to actually do the financial statements. They can simply ask us what total revenues are, what total operating expenses are, what total profit is. Then they can ask us what total retained earnings is, what total current assets is, what total intangible assets is, then what total assets is. So necessarily, you don't necessarily have to do the statements, but you have to know the statements just in case the teacher puts it on there. Also, we need to know the statements so we know how to arrive at these values. What is total current liabilities? They could simply ask you that. What's total long-term liabilities? What's total liabilities? So I've seen questions in that format as well, right? And what's total equity? What's total liabilities and equity? What are total cash flows from operating activities? This will be positive 20,220. What are total cash flows from investing activities? That'll be negative 14,340. What are total cash flows from financing activities? 24,300, right? So these following statements are very important. So please practice this. It's very important.